In your hand right now, you're probably holding a dollar bill, maybe a 20. Look at it closely. That piece of paper is, according to the Federal Reserve, worth $20. But here's what's strange. If you walked into any coin shop in America today and tried to exchange that $20 bill for the equivalent value in silver at the official spot price of $29.50 per ounce, you'd discover something unsettling. The dealer would charge you $34.80 for that same ounce, not $29.50, $34.80. That's an 18% premium over the price Bloomberg shows you on your screen. Now multiply that premium by the 950 million ounces of physical silver that industrial users will demand this year. Multiply it by the 206 million ounces that just vanished from COMEX registered vaults in the last 6 months. And suddenly you're staring at a market that's screaming something the price doesn't want to say. This is not about silver going up. This is about the paper market becoming a fiction that reality is rejecting. Here's what they're not telling you. At 2:17 a.m. Eastern on December 18, 2025, the CME Group, the entity that runs the COMEX Futures Exchange, quietly posted a rule change to their website. No press release, no announcement, just a technical bulletin that increased margin requirements on silver futures contracts by 23%, effective immediately. This was the third margin hike in 41 days. When exchanges do this, they're not managing volatility, they're containing a crisis. The official story is that increased margin requirements protect market integrity during periods of high volatility. But the data shows something else entirely. Every single margin hike since November has occurred during Asian trading hours, when New York is asleep and liquidity is thin. Every single one has been followed within 72 hours by a coordinated sell-off in paper silver that sends the futures price down 4 to 7%, despite physical premiums continuing to widen. This is not risk management. This is price suppression during a delivery crisis. Let me explain the mechanism. COMEX silver futures operate on leverage. A single contract controls 5,000 ounces of silver. At current margin requirements, you can control that contract with roughly $16,000 in posted collateral. That's a leverage ratio of approximately 9 to 1. When you increase margin requirements by 23%, you force leveraged speculators to either post more cash or liquidate positions. Most choose liquidation. The selling pressure from forced liquidation drives the paper price down, even as physical silver gets harder to acquire. But here's what makes this urgent. On January 1st, 2026, less than 4 weeks from now, new Basel III banking regulations take full effect in the United States. Under these rules, banks must treat unallocated gold and silver as liabilities requiring full capital reserves, not as assets. This is the same regulation that already caused chaos in European precious metals markets when it went live there in June 2021. The London Bullion Market Association saw trading volumes collapse by 32% in the 3 months following implementation. Premiums on physical metal in Europe spiked to levels not seen since the 1970s. American banks hold approximately $89 billion in paper silver exposure through unallocated accounts, ETFs, and derivative positions. When Basel III hits, they will be forced to either convert those positions to allocated metal, requiring physical delivery, or liquidate them entirely. There are 2.1 billion ounces of paper silver claims in the global banking system. There are 340 million ounces of actual registered silver in COMEX vaults. The math doesn't work. It has never worked. And in less than 4 weeks, that mathematical impossibility collides with regulatory reality. This is where the lie becomes unsustainable. Paper silver and physical silver are supposed to be the same thing. They're priced the same, they trade with the same ticker symbols. But paper can be created with a keystroke. Metal cannot. Paper settles with a ledger entry. Metal requires a forklift, a vault, and armed transport. For decades, this distinction didn't matter because everyone accepted paper promises as equivalent to physical possession. Trust made the system work. That trust is breaking. Right now, if you want to buy 1,000 ounces of silver from a major dealer, you can get spot price plus 12 to 18% for immediate delivery. But if you want to buy a COMEX futures contract representing 5,000 ounces and take delivery, you'll wait 6 to 8 weeks and pay an additional delivery premium of $2.50 per ounce on top of the futures price. The physical is more expensive and takes longer to get than the derivative that's supposed to represent it. This is backwardation. It's the market screaming that paper promises are worth less than the underlying asset. It should not exist in a functioning market. Yet here it is. The leverage ratio I mentioned, 9 to 1, is actually conservative. That's just the futures market. When you factor in unallocated banking accounts, ETF share creation, and over-the-counter derivatives, the real leverage in the silver market approaches 100 to 1. For every physical ounce sitting in a vault somewhere, there are 100 paper claims against it. At 100 to 1 leverage, a 5% move in the underlying asset creates a 500% move in the derivative. This is why exchanges keep hiking margins. A sustained rally in physical silver doesn't just move the futures price, it triggers cascading margin calls that could vaporize counterparties. But here's what's changed. For 30 years, this leverage worked because no one asked for delivery. Industrial users bought from miners and recyclers. Investment demand was modest. Central banks sold. The paper market was a casino, and as long as the chips stayed on the table, the game continued. In 2024, that changed. Global investment demand for physical silver rose 29% year over year. Central bank selling reversed to buying, and industrial demand from solar panels, electric vehicles, and defense applications hit record levels. Suddenly, people started asking for the metal, and the vaults started emptying. COMEX registered silver, the metal available for delivery against futures contracts, has fallen from 418 million ounces in June 2020 to 206 million ounces today. That's a 51% decline in inventory, while open interest in futures contracts has increased by 34%. The ratio of paper claims to available metal has gone from 47 to 1 to 112 to 1 in 4.5 years. Every month, the divergence widens. Every month, the system gets more fragile. And every month, the emergency measures get more desperate. Less than 96 hours remain before the CME's latest margin increase takes full effect. At 6 p.m. Eastern on December 31st, every silver futures position will be subject to the new capital requirements. Traders holding positions through year-end will need to post an additional $3,700 per contract or face forced liquidation. Given that there are currently 173,000 open contracts, that's $640 million in additional margin calls hitting the market simultaneously. Some of those positions will be closed. Some will trigger cascades into related markets, and all of it will happen during the lowest liquidity period of the year, the week between Christmas and New Year's. This is what a stress response looks like. The Federal Reserve isn't involved yet, but their fingerprints are all over the regulatory pressure. The Basel III implementation that takes effect January 1st was delayed twice by U.S. regulators, first in 2021, then again in 2023. Each delay bought time for banks to unwind positions and reduce exposure, but time ran out. The international framework required compliance, and now American banks face the same reckoning that European banks faced 2 years ago: convert paper to metal or admit the metal doesn't exist. JP Morgan Chase holds approximately $14.3 billion in silver derivative exposure, according to their most recent OCC filing. Bank of America holds $6.8 billion. HSBC holds $4.2 billion. These are not speculative positions. These are client liabilities, promises to deliver metal on demand from industrial users, mints, and institutional buyers. When Basel III takes effect, these promises become balance sheet liabilities requiring full capital reserves. The banks have three options: acquire physical metal to back the claims, pay cash to settle the claims, or declare force majeure and default on the contracts. Force majeure has only been invoked in modern precious metals markets 3 times. By the London Metal Exchange during the nickel crisis of March 2022, by the Zurich Gold Pool in 1968, and by the London Bullion Market Association during the COVID lockdowns of April 2020. Each time, it marked the end of a price suppression regime and the beginning of a new pricing paradigm. Each time, physical premiums exploded and paper markets lost credibility. We are watching the setup for the 4th event. The last time margin requirements were hiked 3 times in 6 weeks was October 2008. Silver futures fell from $19.50 to $8.40 in 6 weeks as forced liquidation cascaded through over-leveraged positions. But that was different. In 2008, there was a deflationary collapse. Credit was contracting. No one wanted assets. Today, credit is expanding at 8% annually, M2 money supply is at record levels, and physical demand is structural, not speculative. The forced selling is happening in paper while physical gets bid higher. The correlation has broken. The mechanism is the same, but the underlying reality has reversed. While one side prints, the other side takes possession. Here's what I mean by that. While the CME raises margins to suppress paper prices, the People's Bank of China bought 29 tons of gold in November 2025 alone, their 17th consecutive month of purchases. While Western banks liquidate unallocated accounts to meet Basel III requirements, the Shanghai Gold Exchange saw physical delivery volumes increase 43% year over year in Q4 2025. While COMEX silver inventories fall, the Central Bank of Russia added 8.2 million ounces of silver to reserves in the last quarter, the first time they've reported silver reserves separately since 1998. This is not about price. This is about who controls settlement. In the West, settlement happens through ledger entries, netting agreements, and cash adjustments. Contracts are promises backed by legal systems and regulatory frameworks. In the East, settlement happens through physical transfer, vault receipts, and possession. Contracts are claims on atoms, not digits. For decades, Western financial engineering could create synthetic supply through derivatives, satisfying demand with paper promises. Eastern buyers accepted this system because dollar liquidity was necessary for trade. That necessity is ending. The BRICS nations, Brazil, Russia, India, China, South Africa, along with new members UAE, Egypt, Ethiopia, and Iran, now represent 36% of global GDP and 47% of the world's population. At their October 2024 summit in Kazan, Russia, they finalized a commodity-backed payment system that bypasses SWIFT and settles in gold, oil, and strategic metals, including silver. The system went partially live in November 2025, with bilateral oil trades between Russia and China settled in gold-backed digital instruments. No dollars, no Western banks, no paper promises. This matters because it removes the incentive for Eastern central banks to hold dollars or dollar-denominated assets. If you can settle trade in commodities or gold-backed instruments, you don't need treasury bonds, you don't need dollar liquidity, and you don't need to accept paper promises from Western exchanges as equivalent to physical metal. The entire architecture of the post-1971 monetary system rests on the world's willingness to accept dollars and dollar derivatives as settlement. When that willingness erodes, the leverage pyramid that supports Western financial markets loses its foundation. Atoms versus digits. The West has leverage. The East has metal. Only one of these is a liability. The West can create infinite paper claims through financial engineering. The East can take delivery of finite physical atoms through patient accumulation. For 30 years, this didn't matter because the system never experienced stress. Now it's experiencing maximum stress. And the divergence between what's claimed on paper and what exists in physical form is no longer an accounting footnote. It's the central fact of the market. India imported 238 million ounces of silver in 2024, the highest annual total since 1998. Mexico, the world's largest silver producer, is now a net importer because domestic industrial demand exceeds mine production. China's solar industry alone consumed 198 million ounces in 2024, up from 87 million in 2020. Defense contractors in the United States burned through 14% more silver in 2024 than 2023, driven by missile production and electronic warfare systems. Every single source of industrial demand is growing. Every single source is inelastic. You can't build a solar panel or a missile without silver. And every single one of these buyers is now competing for physical metal in a market where inventories are falling. This is what a system looks like when it runs out of time. If the paper price rises, short positions at bullion banks face catastrophic losses, and delivery demands surge from industrial users who rush to lock in physical supply. The COMEX could see a run on vaults that it cannot satisfy. If the paper price is suppressed through margin hikes and coordinated selling, the divergence between paper and physical widens further, physical drains faster from vaults, and trust in the paper market collapses entirely. Either outcome breaks the system. Every intervention to prevent one outcome accelerates the other. There is no policy response that doesn't worsen the underlying problem. The Fed can't print silver. They can print dollars to buy silver, but that drives the dollar price higher and exacerbates the very inflation they're trying to contain. The CME can raise margins to force speculators out, but that only suppresses the price signal without addressing the physical shortage. It's like turning off the fire alarm because you don't like the noise. The mathematics don't care about intentions. They don't care about regulatory authority or institutional credibility. They care about atoms versus claims. And the ratio is 100 to 1. The pressure valve has been welded shut. In a normal market, price would rise to balance supply and demand. High prices would incentivize new mine production, encourage recycling, and ration demand. But this isn't a normal market. This is a market where the price is determined by paper contracts trading on leverage, not by physical supply and demand. The price signal has been jammed for decades, and now, when the system most needs price discovery to allocate scarce resources, it can't let price rise without destroying the over-leveraged positions that control price formation. It's a pincer movement, with no retreat. The last time this happened was 1971. The London Gold Pool had been suppressing gold prices for a decade by coordinating central bank sales whenever price threatened to rise above $35 per ounce. By 1968, the pool was selling 100 tons per month to defend the peg. On March 14, 1968, they gave up. Gold was allowed to trade freely while official transactions remained at $35. Within 3 years, the system collapsed entirely. Nixon closed the gold window on August 15, 1971. The Bretton Woods system ended, and gold went from $35 to $850 over the next 9 years. This is what a death spiral of intervention dependency looks like. You intervene to suppress price. The intervention creates more stress on physical supply. The physical stress requires more intervention. Each intervention is larger and more desperate than the last, until the intervention itself becomes the crisis. We are watching that pattern repeat in real time across precious metals markets. The margin hikes are getting more frequent, the settlement delays are getting longer, the physical premiums are getting wider, and the inventories are getting smaller. Before January 1st, 2026, every major bank with unallocated precious metals exposure will have made a decision: acquire metal, settle in cash, or declare force majeure. The decisions have likely already been made. The only question is execution and announcement. Some will choose cash settlement, simply paying clients the dollar value of their metal claims and closing the accounts. This removes the liability from their balance sheet, but floods the market with dollar-denominated selling pressure. Others will attempt to source physical metal from the market, bidding up prices and draining remaining inventory. A few may attempt to negotiate delivery delays or contractual modifications, hoping clients accept paper promises for longer. None of these options solves the problem. They just redistribute it. Cash settlement doesn't create silver, it converts metal claims into dollar claims at a moment when dollar purchasing power is eroding and inflation expectations are rising. Buying physical from the market just moves the shortage from bank vaults to dealer inventories. Delivery delays and contractual modifications destroy trust in the system at precisely the moment when trust is the only thing holding the paper market together. Here's what the informed are doing. Central banks that stopped reporting gold purchases in the 1990s are now filing monthly updates showing steady accumulation. Sovereign wealth funds that historically held 60% bonds and 40% equities are now allocating 15 to 20% to physical commodities and strategic metals. Large institutional buyers are taking delivery of metal from exchanges rather than rolling contracts forward, even though delivery is more expensive and logistically complex. These aren't speculative trades. These are positional moves made by entities that understand the difference between claims and possession. The question isn't whether to panic, it's whether to understand. Most will react to price. They'll watch Bloomberg screens and see silver at $29.50 and think nothing has changed. A few will understand mechanism. They'll see backwardation, falling inventories, rising industrial demand, margin hikes during Asian hours, Basel III implementation, and Eastern accumulation. They'll recognize these are not independent events. They're the visible symptoms of a system under terminal stress. Markets can remain irrational longer than you can remain solvent, but not longer than physics permits. Paper can promise infinite supply. Reality delivers finite atoms. Paper can trade on leverage and sentiment. Metal moves by forklift and vault receipt. For decades, the system convinced everyone that these two things were equivalent, that a promise to deliver silver was the same as silver itself, that a ledger entry was the same as a bar in your hand. And for decades, that worked because no one tested it. The test is happening now. In less than 4 weeks, Basel III forces banks to prove they can deliver what they've promised. In less than 96 hours, margin requirements rise again and force more paper liquidation. Every day, industrial users consume more metal than mines produce. Every month, vaults empty while paper claims multiply. Every quarter, the divergence widens. This is not prediction. This is observation of mechanisms already in motion. The divergence between paper and physical is not a market anomaly. It's reality reminding us that gravity still works, even in finance.